So if you're just getting started, and I always recommend that you start small, this could be your season, because small is actually, in my view, going to be a better place to be in the near term. And so this is a time for newer people to build their businesses, to get your systems up, get your networking going, build your base of prospective investors, build your software tracking systems, underwriting tools, all of those things, because when the market starts to turn into your favor even more, you're not going to have time for all that business development stuff because you're going to be busy doing deals. So get everything ready now, and then you can harvest that seed that you planted when it starts to produce some fruit.
Tim is one of the most authentic and genuine people I've ever met.
I sincerely believe he's coming from a position of giving, and that means a lot.
You're going to make huge progress.
Welcome everybody to today's Capital Raising Show. I'm your host, Tim Mai, and today I have an amazing guest, author of The Hands-Off Investor, an insider's guide to investing in passive real estate syndications, Mr. Brian Burke. Brian is the president and CEO of Praxis Capital, Inc., which is a vertically integrated real estate private equity investment firm, which he founded in 2001, way before most of us have got started in real estate. And some of you young ones, you probably wouldn't even born back then yet, maybe. Well, unless you're really young, I guess. Jada might be like right around that time there. Brian has since acquired over $800 million worth of real estate. That's a lot of real estate, Brian. Yeah, including over 4,000 multifamily units, more than 700 single-family homes, the assistance of a proprietary software that he wrote himself. It's amazing. Brian has subdivided land, built homes, constructed self-storage, but he preferred to reposition existing multifamily property. So we're going to dive further into that. Brian has since, in the last 30 years, has raised over $300 million of investment capital, equity capital. So with that, let's give Brian a big welcome, y'all. Woohoo! Give you a big Texas welcome.
Thanks, Tim. It sure is great to be here.
Awesome. So great to have you. So Brian, oh gosh, I mean, your story goes way back. Do share with us how you got into real estate. What got you into real estate to begin with?
Oh, that's a really good question. You know, I didn't think I had any better options. I knew that I was not going to make a good employee for anyone, and I knew that I didn't know anything about really pretty much anything. So I read books that said that you can invest in real estate even if you had no money and don't know stuff. And I thought that description fit me pretty well. So I figured I'd try my hand at investing in real estate. And once I got started, I really never looked back.
That's awesome. So you never worked at a W-2 at all, or like you just skipped the whole thing?
No, I wish. No, I was in law enforcement for 14 years. And
Okay.
that was like a nights and weekends job. And so while that was great, it gave me, the best part about it was it gave me basically the business week off because I was working in the evenings and weekends. So during the daytime, I would be researching title, going to foreclosure auctions, driving by houses, and then I'd go to work in the evening, and then the next day I'd repeat the process. And so it was a 7-day-a-week lifestyle for a lot of years in the early part, for sure.
I see. Okay. So share, I mean, I know you've done a lot of different things, but share with us, what does your business model looks like now?
Now actually right now, it doesn't look like much of anything because the market's been so terrible. I started selling. I thought, I kind of saw a peak of the market coming about 2 years ago. So I started selling. I sold 3/4 of my portfolio over the subsequent 18 months. And so the last time I bought anything was almost 2 years ago. The last thing I sold was about a year ago. So since then, we haven't really been doing much of anything other than watching the market and waiting for the right time to jump back in. Haven't seen the signals I'm looking for yet. So right now it doesn't look like much, but what it would look like if the market would cooperate with me is we'd be right back to where we were before, which is buying multifamily apartment complexes. So our core strategy is we buy 100 unit and larger multifamily assets that are built after 1980. We prefer built after 2000. So like newer class A to B minus multifamily in growth markets. So mostly in the southeastern US, or at least the southern US for sure. And, we buy them, make improvements to enhance revenue and hold them for a period of time and then resell them when the time is right.
I see. Okay, let's definitely dig into that, because with you being in this business for 34 years now, this is your third market cycle. Is that correct?
At least, I mean, there's been a lot of little tinier cycles that have been in the middle of that. But yeah, absolutely. I've seen my share.
Yeah. So I would love to hear what was happening in the market that have you spotted that 2 years ago was time to get out? Because I have friends who've been in the business long as well, and they got out so early that they're like, man, I got out too early, right? And and so what was it that had you stayed in? I mean, 2 years ago, you timed that thing spot on. So what was it that you saw, so that way it will help us, to catch the next market cycle, I guess.
Yeah, I tend to react to contrarian signals. So for me, the strongest signal of a market top is when the buyer euphoria reaches incredible heights. In other words, when everyone wants to buy, in my view, it's time to get out. And so we had a property that we got an unsolicited offer for a couple of years ago that would have been way above what we would have predicted that property would have sold for.
Mm-hmm.
And that was the first signal. So then we thought, well, if that could happen once, let's try it again. So we put another property on the market, and we got like 24 offers, way over pricing guidance, very
Wow.
large, non-refundable earnest money deposits, no contingencies, kind of like almost like no inspections, no questions asked.
Wow.
Take our pile of money. So far be it from me to say no. So we put that property in contract, and that price was about double what we paid for it a year and a half prior. So I mean,
Wow.
we're talking like, you buy for 20 million, sell for almost 50 million.
Oh my gosh.
When stuff like that is happening inside of 2 years, that you've kind of reached a peak. And so that, in the face of 30% annual rent growth in some markets, which is unsustainable, and knowing that buyers were underwriting as if that kind of rent growth was going to continue, it told us that we were probably more likely to receive the highest price possible at that moment. And if we waited, it would only go down from there. And, we could wait for decades or years and maybe surpass that, but that would just, time value of money would kill the IRR. So it just made the most sense to us to pretty much sell everything we owned, save for a few assets that were somewhat recently bought, class A stuff that hadn't gone up in value like the other assets, but also were early in their business plans and had the time to ride it out to the next market cycle peak, which was the plan anyway.
Gotcha. Wow. That's definitely a very smart move. So like, if, for those of us who didn't have a property to list to kind of tell, what are other signals would you say would have given that away?
Oh, you don't have to have something to sell. You could be on the buy side of it. And that was also another signal that we were also getting, as we were looking at, acquiring stuff. And when we would put in offers and get outbid by 10 or 20%, literally millions of dollars apart from, where the winning offers were coming in, yeah, that's another signal. So, when you underwrite something reasonably and you say that everybody else around you is crazy, I mean, that's always like that always happens. Don't get me wrong. Anytime you bid on anything and don't get it, you always think the other guy's an idiot. That's just kind of part of the recipe. But I mean, when they're like really, really out of a higher than you, and it's consistent and in volume, that's a signal. So you don't have to be on the sell side to see that. You can see it on the buy side.
Gotcha. Yeah, that's good. Now, I mean, with all the market that you've been through, what is this market telling you now? Like, what are you thinking that this market is how is it gonna play out? What are the similarities it might have in the past markets, or is it completely, different? What's your crystal ball is telling you?
It's not really all that different, but what it is telling me is the market's telling me a couple of things. It's telling me it's confused, and it's telling me that it's trying to find its footing. Right now, we're in a standoff between buyers and sellers, and each side is trying to see who's going to blink first. Buyers are saying like prices right now are crazy high. They don't make any sense. I can't underwrite a deal and have the numbers work. Sellers are saying, no, my property is worth way more than that because it was worth way more than that. So therefore it still must be worth way more than that. So there's no way I'm selling at that price. And until those two can get on the same page, nothing is happening. So what you're seeing in the market right now is just a lack of transaction velocity. Nobody's getting anything done. And I totally get it. I mean, as a buyer and a seller myself, I'm not going to buy any of my own properties for the price I would want to sell my own properties for. So if I can't get myself on the same page, you certainly can't get two unrelated parties on the same page. And part of that is just because there's so many things that are in flux right now. For example, interest rates are on the move. Now there's debate, and we can debate this all day long about what direction they're moving. They've been moving up, that's undisputed, but where do they go from here is the big question. A lot of people think they're going higher. Some people think they're staying the same. Some people think they're going to go down. And until there's a consensus on that direction, at least, that makes it difficult to transact. Rent growth was absolutely through the roof, double-digit positive almost everywhere. Now we're seeing negative rent growth in a lot of markets. In fact, on a national basis, there was an article came out the other day of national rent decline over the trailing 12-month period, just by a slight margin. So when rents are on the move, that impacts the way people underwrite future income or the income growth of the property they're looking to acquire. So if you can't put your finger on it, you can't nail that down. So, between interest rates and occupancies and inventory that's being added to the market and all that stuff, it's just very difficult to come to agreement on pricing right now.
Gotcha. Okay. All right, let's switch gear a little bit. You mentioned multifamily is your favorite out of all the things that you've done. Why is it among your favorite? And then why do you choose, A to B minus, when, there's a lot of people well, not in this market, but when the market was hot, a lot of people were like C's and, bigger value add and stuff like that. But, yeah, so share with us some of your thought process into the asset class.
Yeah, so I've done almost every asset class, and I've found that I'm best at multifamily. And I think in part because I have a residential real estate background. I got my start as a house flipper, then as a, smaller time landlord, and then a bigger time landlord, and kind of worked my way up through residential real estate. Not so much in industrial, commercial, hospitality. It really kind of depends on where you cut your teeth, I think, into where you find your niche. I found that if I stray too far outside of the lines, I get my hand slapped. So it's just better for me to stick to my core competency, which is in the residential side. So that's one of the reasons I like it. The other reason I like it is residential to me is more resilient. As opposed to office properties and some of the other asset classes that can be in favor one day and out of favor another day. I mean, look at what's happening to office in San Francisco and New York. I sure wouldn't want to own any of that stuff right now. So but multifamily just it sings pretty well. In terms of the classes, A, B, C, D, F, there's a lot of opinions on all that. I feel like newer investors tend to gravitate towards C, probably because experienced investors don't want to touch it. So it's the only thing they can get. Newer investors try to buy A or B, and they get outbid by more experienced or sophisticated groups. So they're like, well, hey, here's this great opportunity to enhance revenue because the rents are really low and collections are really bad. When then only through experience do they learn that collections are low because nobody wants to pay, and that trying to get people to pay is a real struggle. That when the economy turns and those people lose jobs, it's really, really bad for them. And then to make matters even worse, especially over the last 3 or 4 years, the pricing delta between Class C and Class A was minuscule. I mean, if you're getting a 0.25% cap rate premium on a Class C property versus a Class A, that's zero incentive in my book. So there's just been no reason to get into Class C. I've done it. I've been there. I've graduated from it. I never want to go back and do it again. It's too much heartache, too much headache, and too much work. So Class A and B are a better fit for our strategy where we are in our current business model. Now, if you're just getting started out, your answer might be different.
Right. Yeah, I know, like, of all the bad deals that are happening right now, the deals that are in trouble, I should say, all the deals that are in trouble right now, majority of them are Class C's. So yeah, I get it. What about, in a down market, what happens to Class A? People can't afford it. They do, like, yeah, that was the other counter to, investing in Class A. So can you share with us your insight into that?
Yeah, the old adage is that when times are tough, the A people move into a B, the B
Right.
people move into a C, the C people move into a D, the D people just wait for the sheriff to evict them. It's in my experience, that's not been what happens in the real world. The A people don't move to Bs. Instead, what happens is the A's will get a roommate. They'll find a way to stay in their apartment. They don't want to downgrade. People don't generally downgrade. Once they get to a place, they tend to want to stay there unless they're forced to. Now, oftentimes you'll see people that might move back in with their parents or whatever the case may be. But just to have somebody move from an A to a C is a real stretch. It's a lifestyle change that most people aren't willing to make. So I just don't see that as being a factor. Now what you do see is you might see occupancy trail, and then you'll see concessions. And so you might have to give away 2 weeks free rent to attract, fresh tenants. You might have to give away, a $200 discount or no security deposit or whatever it is to just attract people. But all the classes of property are going to have to do that. And if you were to balance off the concessions you give to A tenants versus the turnover cost and eviction cost of a C class, I think you're still going to find that A wins the day.
Interesting. Yeah, I a few months ago, I was touring some B class, and I see 2 months concession. Like, wow, I haven't seen those 2 months concession in a long time.
Yeah, and there might have been a lot of development in the neighborhood or in the area too. Then you'll start to see that, because oftentimes what happens when a new property is built, new projects don't want to discount their rent because that doesn't look good for their lender. So what they'll do is they'll give away free rent, and now you're in competition with that. So, the weird thing is, like, if you own duplexes, triplexes, single family homes, the broader market doesn't necessarily represent your experience. You might be able to, have a fourplex and occupancies could be 75% in the market and you could be 100% full, just because the numbers are so small for your representative sample. But when your property size gets bigger and you start getting over 100 units, you're going to reflect the broader market. If the broader market's occupancies are declining, your occupancy is going to decline. If the broader market is offering concessions, you're going to be offering concessions. And you just have to, kind of follow the trend of where that's going and be realistic about where the market is if you want to maintain your occupancy and react to it.
Right. That's really good. All right, let's go talk about your book. Your book focuses specifically for passive investors, right? So share with us your, what had you decide to write a book, and how effective has it been for you in terms of attracting passive investors?
Well, I think what attracted me to writing a book was the fact that I think after as long as I'd been doing this and as much as I had done in my career and the outside pressure of everybody asking when I was going to write a book, this is probably the only way to stop having those questions being asked, is to finally write it and then be done with it. Thankfully, that's put an end to that. Now I'm starting to get the when's the next one, but I'm ignoring those for now. But really, a couple things motivated me to write this book. You're right. This book was designed to teach passive investors how to properly invest in passive real estate syndications. And that came about from two primary things. One is a friend of mine lost her entire life savings investing in a passive real estate investment. And I felt like if I could do something to help prevent that from happening to just one other person, it would be completely worth the effort. And the second thing was that in talking with prospective investors that had contacted us to invest with us, I found it really interesting that even so-called accredited investors don't really know what they're doing. Oftentimes, they don't know the questions to ask or the right questions to ask or what to look for or how these things really work. Let's face it, the only requirement for being an accredited investor is $1 million net worth. And not that that's an easy thing to achieve for anyone, but it doesn't mean anything in relationship to your knowledge of investing in a passive real estate syndication. So I felt like there was a need for, and what I discovered was it didn't already exist. There was a need for an avenue for people to learn what to look for and what to invest in and what not to. So that's what started it all.
Gotcha. I love that. Especially the reason is because of what happened with your friend. Yeah, like in this market especially, I think that's a concern for a lot of people, and then deals going bad and foreclosures. Like it is time for your second book.
Yeah, well, there's one in the making right now. Apparently, just looking around at what's happening right now, there's a lot of material for a second book going on out there. That's for sure. I mean, you're right. You are starting to see multifamily foreclosures. You're starting to see capital calls. You're starting to see deals running into trouble. Now, the common thread amongst all of that, I mean, you mentioned earlier, it's mostly Class Cs that are in trouble. And while there's a lot of truth to that statement, really where you're seeing the distress coming from today is the same old thing that caused the distress in the great financial collapse, and that's too much leverage. The most of the deals that are in trouble have a problem of a two-pronged problem. Number one, they borrowed too much, and number two, they borrowed it with too short of a maturity. And this is where they get stuck, right? I've got a 3-year loan with 2 1-year extension options. That gives me 5 years. And, when you're a 30-year-old real estate syndicator, 5 years seems like a long time. It's, 20% of your life or whatever. But when you do as long as I have, 5 years is a blink of an eye. And so you learn that that's just not enough time if something doesn't go perfectly for you. And I think people are discovering that now that, that 3 years ran up really quick and now they want their 1-year extension. But, oh, by the way, you don't meet the debt service coverage covenant to qualify for the 1-year extension. So you can't have it. And now you got to pay the loan back, and there's nowhere for them to go.
Yeah, for sure. So back to the book, I would love to, how are you utilizing the book right now? Is it do you actively promote it? Do you and then also, has it been a good, effective tool for you in terms of, attracting new investors or converting, prospects into investors?
Well, I used to tell people all the time, I'm the absolute worst marketer. In the 34 years I've been in this business and the over $300 million I've raised, not a dollar of it has come from any advertising. I don't do any advertising. I don't do any marketing. I don't do any of that stuff. But when the book came out, I didn't get any better. I don't promote the book. I don't advertise it. I'm not the publisher. Bigger Pockets published it, so they pretty much
Okay.
handle all the marketing. So I don't really do any of that. Now I do podcasts occasionally, and usually some discussion comes out of that podcast surrounding the book. But really, the marketing is done for me. The people who have read the book recommend it. And that is really, the word of mouth is really the primary driver. It's not the kind of book that appeals to the masses. It's very specialized subject matter, and it's a very technical book. And if that's the thing you're into, you'll recommend it to your friends, but an advertisement isn't going to get there. And as it relates to my efforts to raise capital, certainly I think it's an unintended side effect. It's not why I wrote the book, but oftentimes people will read it and they'll say like, geez, it's a lot of work to figure out who to invest with. Why don't I just invest with the guy that wrote the book on how to invest? So we do get a lot of people that come out to us and want to invest because they read the book. But that certainly was, we didn't write it to be an advertising mechanism for us.
I see. Okay. Well, yeah, glad it works out that way. So let's talk about marketing or lack of. Raising $300 million is a lot of money. And that's super impressive to do it without all the marketing. How have you been able to raise money if you don't, you're not out there constantly promoting yourself?
Oh, it's easy. I don't have to. You just perform for your investors. You communicate well with your investors. You tell your investors what's happening honestly, and you don't have to do any advertising. They'll do it for you. All of our growth has been by word of mouth. Now, it's not the fast track to wealth. Believe me, I've been doing this for over 30 years. And, the first 15 years was a slog. But I probably finished year 15 having raised, $5 or $10 million because it's very slow. When I first started in this business, I didn't know a soul that had two nickels to rub together. I was when I made my first real estate investment, I was working in a grocery store making $13 an hour. Then I spent 14 years in law enforcement where I worked with a bunch of cops who were making, less than 80 grand a year. But when I left that job, I put together a fund, and I put in my notice to the police department. I told the guys, I'm out of here. I'm going to tell people what I'm doing about real estate at this thing. I rented out the room at the community center. Why don't you all come? So they did. And I told them about what I was doing in real estate. I said, if you guys will invest with me, I'll take investments as small as $5,000 and I'll split the profits 50-50 with you. And I'll be damned if I didn't walk out of that meeting with 500 grand in commitments from investors. And that was the start of my raising money career. And from that moment forward, it was all word of mouth. And of course, most of the people that were investing with me, they didn't know rich people. So I was getting small investments. And then it took a lot of time to get to the point where I was attracting accredited investors. It took an extensive track record before we could get people who were wealthy and could write bigger checks and write them consistently. It took a lot of years and going to conferences and meeting people and talking to people. But most importantly, it was performance. It was, people will see what you're made of by watching what you do, not listening to what you say.
Right. Yeah, that's definitely spot on. I'm just curious. So that very first meeting, how much in commitment did you get out of that very first
I got $500,000 of commitment from 28 investors carrying guns. And if that doesn't convince you that you have to make sure you don't lose your investors' money, I don't know what will. And knock on wood, 34 years later, I've never lost a nickel of investor principal, and I have no intention of starting. So that was
That's good.
interesting way to start out.
Yeah, that is interesting. And 500,000 for your first meeting, that's very impressive. That's really good.
Yeah, it was. But remember, I'm also coming into it with a couple dozen deals under my
Right.
belt that I could show as a track record. And that's why people were willing to bolt on to what I was doing, is because I
Right.
could say, look, this is what I've done. This is what I bought this for. This is what I spent fixing it up. This is what I sold it for. This is the profit that I made. You guys invest with me and I'll split the profits on future deals 50-50. They could see what you did. They can kind of see what you're going to do.
Right. A lot of the people on this call, we are, I don't know, but a lot, but a good portion of us are fairly new to the industry. We don't have the track record that that a lot of seasoned people have, and we're coming in to help with capital raising, either as fund of funds, possibly even co-GP. And how do you what would you recommend as a way to how to navigate that and still attract the passive investors, especially the bigger ones?
Well, raising money is really, there's 3 different tests you have to pass to raise money. And if you can pass all 3 tests, you'll raise money. The first test is the person who you are looking to make this investment has to trust the type of investment that you're proposing to make. So in this case, let's say it's real estate. The investor has to trust real estate. And this is one of the biggest problems that a lot of people get themselves tripped up on, is they go out and they go, oh, I'm raising money for this real estate deal. And oh, real estate, that stuff is hogwash. You can't make any money doing that. Get rich quick stream, late night TV BS. And, when that's the reaction, you're wasting your time with that person. But people will tend to want to, oh, no, let me convince you why real estate is great. And you get this and that and tax benefits and blah, blah, blah. If that's the level of education that you're having to provide that investor, it's unlikely that you're going to get them to invest with you. So the first test that has to be passed is they have to trust the type of investment that you're asking them to make. The second thing is they have to trust you. And if they don't, and this is probably out of all of the 3, this is the biggest test. If they don't trust you, there's 0 chance they're ever going to give you a dime. Forget about it. But if they do trust you, that's a huge step. Now, there's a lot of sub components to that, like how do you get them to trust you and all those kinds of things. Well, really, it comes down to your personality, your trustworthiness, your honesty, your track record. And so the biggest one is track record. And if I didn't say track record, then it's track record. And if you don't have one, then you have to look to people who trust you for reasons not related to your track record. Like, for example, they might share DNA with you. They're a family member, a friend, or relative, somebody close to you, somebody that they changed your diapers when you were a kid. I mean, whatever it was, they trust you for some other reason. If you're going out and you're like, I've never done a real estate deal and I'm going to go attract accredited investors to invest in my real estate deal, it's just not going to happen. They're not going to place that level of trust with you because they don't know you. You don't have a track record. So it's just not going to happen. So you got to find people that trust you. And the third test is they have to trust the deal that you're presenting to you. So they could say, hey, love real estate, love you, you're awesome, you know exactly what you're doing, but that deal that you're buying is a piece of junk on the wrong side of town, and that's a crime-ridden this and that and whatever. They're not going to make the investment. So if you can satisfy all 3 of those, and you have the audience, you'll raise money. That's really all it takes. People overcomplicate this, but that's really all it comes down to. This is a trust business. Money is very hard to come by, and no one's going to let go of it unless they feel that they're going to get it back and then some. And they have to trust that that's what's going to happen.
Right. One of the things that does help for the people who don't have the track record, one of the things that does help too, especially if they're coming on as a co-GP or a fund of funds, and the lead sponsor has a lot of track records, that we can kind of leverage that, right? So like yourself, do you take on fund of funds?
I don't, but you're right in what you're saying. If somebody on the team, somebody's got to have the track record somewhere along the line, right? So if
Right.
you're raising money on a co-GP basis, you want to be able to show that that person has a really strong track record. But that doesn't mean that you're off the hook, because the person that's making this investment is still going to wonder, how do you know that person's any good? What experience do you have in vetting other sponsors? What signals are you looking for that's causing you to say that you think this investment is worthwhile? They're essentially trusting your advice, right? Otherwise, they would just go invest with that other person and just invest directly and cut you out of the middle. There's some kind of value that you're bringing to this equation. And usually that's going to be, look, I've done all the research and all the homework. I've watched these guys. I've seen their deals. I've kept an eye on them for the last 2 years. I invested with them. That's the best one is I put my own money with that person. We did a deal. The thing went full cycle. I got paid back. I made X amount of return. What are they doing to mitigate risk? Well, these guys they're using conservative leverage. They're not taking on too much debt, et cetera, et cetera. You've got to be able to demonstrate why that trust should still be there. It doesn't just completely transfer where you go, hey, these guys are experienced, I'm not, invest with me because these guys are good. It's not enough.
Right. Yeah, that's really good. Yeah, and like having just like, there's due diligence checklist for deals, right? Having a due diligence checklist for the lead sponsors, the general partners, and be able to show that to your investors will also be very good.
Well, and that's where the hands-off investor is helpful, right? I mean, it's all about evaluating real estate sponsors, and that's valuable information and things you should be looking for, on a passive investment, even if you're passively bringing in capital as a co-GP.
It sounds like you get a lot of your business through repeat and referrals. Do you have a way to sort of like, are you intentionally asking for that referrals ongoingly? What's your process for that?
Yeah, I don't have one. Like I said, I'm a terrible marketer. I really don't have a process for it. Our investors will, it's like when people make a smart decision, they want to brag about it, right? So like, yeah, I invested with these guys and I made a great return. I want to tell my friends about this great investment that I made because I'm great. So of course they tell the friends, and the friends want to be great too. We don't go out there and say like, hey, free boat trip for anybody that brings on a $200,000 investor. We don't do that. We don't have a club or, this. I've seen all kinds of different stuff that people do to promote referrals. And I suppose if we did that, we probably could grow even more than we have. But our growth is fine. I don't need more growth. So the pace that we're raising capital works for me. I don't need to get too crazy. So yeah, unfortunately we don't do anything there either.
Gotcha. Yeah, that's good. Have you had deals that gone bad? Like or where you had a capital call, or I don't know, completely gone bad and the investor lost money. Have you had any of those deals before?
Well, anybody that hasn't had a deal go bad either hasn't been doing this long enough or doesn't do enough deals. Because sooner or later, even the best of us have bad deals. Now, having said that, I've never had to issue an unplanned capital call. We've never lost a property to foreclosure. We've never lost a dime of investor principal. So my definition of deal gone bad might be different than someone else's definition of deal gone bad. To me, a deal gone bad is one where we didn't meet the projected return. Now, does that happen? Absolutely. That's especially when you're in the Class C property business. Earlier on in my career, I did a lot of Class C, and it's one of the ways I learned not to do Class C was by being in Class C. And one of the things about Class C that you'll find is that about a third of the deals do extraordinarily well. They're absolute grand slams. About a third of the deals are average, and about a third of the deals are total losers. And I don't mean, in my view, not total loser like, we lost all our money. There is certainly a percentage of those where that can happen, but you might break even or make a small single-digit return, whatever that may be. And so when you blend out the entire Class C landscape, you get an average return that's, somewhere maybe a little bit north of what you could do in Class A or B, maybe on an average basis, but you also have a lot of additional risk. So on a risk-adjusted basis, it's probably no premium. But I've certainly had my share of deals that didn't go according to plan. I had one where this was in the 2008 great financial collapse, where the property was, I used to joke that the property was, half the property was empty and the other half weren't paying. And that was a Class C, and that's kind of how it felt. And there was just enough income to pay the expenses, the payroll, management fees, insurance, water bill, but there was $0 left over for the debt service. So I started servicing the debt out of my own pocket, and I was writing a check out of my own bank account for $15,000 a month to keep the mortgage current. And when I thought that would be for 2 or 3 months, turned into about, 3.5 years of writing $15,000 a month checks. And, those experiences are painful. Now, at the end of the day, the market eventually came back. The prices eventually appreciated. We were able to sell, get back enough to pay all the investors back, pay me back everything I loaned to the entity to keep the mortgage current, as well as give the investors a single-digit return, which to me, that deal was a failure. But to the investors, it was a massive success, because they're like, oh, what? You're sending us our money back? We wrote that off years ago. It's like, well, don't make that mistake, not in my deals. Certainly I've probably had at least 4 or 5 deals that didn't go according to plan that I wish I had never done, but it didn't result in anybody losing their arm.
Right. You have had a really great exit in the last couple of years. And so, and then you are also super patient to just sit out. If it's not a great deal, you're not going to get into it. What would you recommend for the newer people coming on to the market now? Like, how can we, do we need to be as patient as you are and like really just seek out for the best deals? How can we get in here, start doing some deals, but nothing crazy that gets us in trouble and we won't even be able to last in this business. So what are your recommendations for newer people?
Well, there is that old saying, the bigger they are, the harder they fall, right? So there's a lot of people that say like, oh, I won't do anything unless it's over 100 units. And it's like, yeah, how many deals have you done? And they're like, none. It's like your first deal is a 100-unit deal. Probably not the best idea, because when you make your rookie mistake, which you will make, it's going to be a very painful mistake if it's a 100-unit deal. So I recommend staying kind of on the smaller side, especially in times like this, mistakes where you can't get hurt too badly if things don't go according to plan. Now, having said that, what's also very interesting is that right now, there's really not much opportunity in large multifamily because there's just no price. There's no agreement on pricing. There's really no inventory to buy. Sellers in that arena are fairly sophisticated. They're professionals. They're generally well capitalized. This is their primary business in most cases. And so there's just not a ton of volume for you to go out and pick off phenomenal deals, especially as a lesser experienced operator. Now, more experienced operators are going to get off-market deal flow that, might make sense, but, lesser experienced people are going to not have access to that same deal flow. So where I think there's actually more opportunity right now than in large multifamily is in small multifamily. Because your duplexes, fourplexes, 5-unit, 10-unit, 20-unit buildings, this is the market segment where you have the quintessential so-called tired landlord This is the market segment where you have undercapitalized owners who don't have the ability to service the debt on their higher interest rate loan, or they can't find an outlet for their loan maturity that they need to pay off. They're stuck, and there may be some opportunity to get undervalued assets in greater quantity than there is in large multifamily. So if you're just getting started, and I always recommend that you start small, this could be your season, because small is actually, in my view, going to be a better place to be in the near term. And so this is a time for newer people to build their businesses, to get your systems up, get your networking going, build your base of prospective investors, build your software tracking systems, underwriting tools, all of those things, because when the market starts to turn into your favor even more, you're not going to have time for all that business development stuff because you're going to be busy doing deals. So get everything ready now, and then you can harvest that seed that you planted when it starts to produce some fruit.
Right. That's really good. So when you say small, your is the recommendation then under 20 units, or like 20 units or below?
I don't know that there's really a hard number you can say, but I think anytime you're under 75 units, it's a different profile, ownership profile. You get over 75 units, that ownership profile tends to become more sophisticated, professional, advanced, well capitalized. Under 75, less so. And the smaller you go, then generally the less of that sophistication and capitalization you're going to see. So, it could be as much as single family homes and duplexes, triplexes, fourplexes. The bottom line is what you're doing, especially if you're new into this business, the most important thing you can do is build your track record. And so if you can buy 10 fourplexes, you've got 10 properties on your track record now that you didn't have before. And so now when you're going to go do a 20 unit or a 50 unit, you're going to raise money, and, you can show, look, this is what I did. I have 10 4-unit buildings, and I brought the rents from X to Y. I fixed them up, and here's pictures of before, and here's pictures after. Here was the occupancy before, the occupancy after. Here's what I bought it for. Here's what I sold it for. Whatever kind of stuff you can show someone, that's valuable and probably worth more than the real estate that you're buying. The earlier part of my career is what built the later part of the career. And it wasn't from the money I made, it was from the track record I built.
Gotcha. That makes sense. If you look at the bulk of your investors, who's that avatar? And do you focus much on attracting that avatar? Or are they more of random just from all the things that you do?
There's a wide mix of people, which is somewhat surprising. Now, what's not surprising is that we have a lot of tech workers, because I'm based north of San Francisco. So we've got, Silicon Valley and is nearby. A while back, before the pandemic, I was invited to speak at corporate gatherings for Apple, Google, Facebook, Instagram. And so, in talking with those people, and then they tell their friends, and you've got people who are making, $200,000 to $400,000 a year, and they're working, 500 hours a week. So they have no time to actively invest. We do have a lot of tech workers, I think, in our investor avatar. But there's also, fund managers, and, it's all over the board. We've got family trusts and a lot of physicians, the doctor dentist crowd. I mean, everybody's represented in our investor base. But we probably have a slight lean maybe into from tech workers just because of our proximity.
Gotcha. Okay. And did your book help you get those speaking engagement into this corporate?
Actually, that was pre-book even.
Oh, wow.
Those invitations came because we had investors that worked at those companies, and those companies had investment, I don't know what they called them, like subgroups or clubs or something, whatever it is, inside
Right.
the companies, and they can hold events at the headquarters. It was cool for me because I got to go to the Circular Apple campus and the Facebook campus and see all the cool stuff, and I got a tour of Google. I mean, it was a ton of fun. I probably had more fun than they did, but that's it. Again, it was part of word of mouth. It was like, I didn't ask to speak there. We were invited to speak there because somebody that was in our investor base came to us from some other reason, put in the word.
Right. Gotcha. All right. What are some of your favorite tools that you use in your business?
Well, the primary tools that we use, there's really, I'd say, like 3 primary tools. One obviously is the internet and everything on it, right? I mean, Google Maps is huge, data services are huge, CoStar, and just all that information. I absorb a lot of information to make investment decisions and location decisions and that sort of stuff. So that's one major tool. Another major tool is a software package I wrote decades ago now, that we still use to this day in our shrinking single family flip business that's still there. I still have a team that's in charge of running our single family flip business, and we use some software that I wrote to accomplish that. And then third is our underwriting tools for multifamily, which is basically a financial modeling tool to estimate future income and cash flow of multifamily assets will be, and what the subsequent value will be, and what investor distributions would look like, and that sort of stuff. And then I guess to wrap it all up, we use an investor management platform that we use for investor reporting and distributions and that sort of stuff.
Gotcha. So with you having, a software background, are you doing anything with AI to doing these market studies and research and all that good stuff?
No, I haven't I'm too old for AI. I think it's, I don't know. I never thought I was going to be that guy. I was always on the forefront of technology, and now I feel like I'm trailing behind. I really haven't. So I thought I was going to update my website, and I'm like, I haven't updated my website in a few years. I'm going to ask ChatGPT to write me a new website. So I asked ChatGPT to write me a new website, and I'm reading it, and I'm like, this is crap. I'm like, what I have that's like 5 years old is way better than this. And so I ended up not changing anything, and just, I realized, how good it actually was. There's no substitute, in my opinion, for human capital. But look, I know eventually AI is going to take over the world. It's going to have an impact in real estate investment. I'm not sure exactly how yet. Somehow it will, and by then, thank God, I'll be retired and won't have to worry about it.
Awesome. All right, Brian, thank you so much, for all the information and knowledge you share with us today. If the folks listening in want to reach out to you, invest with you, learn from you, where would you like to send them?
I would send them to our website. It's praxcap.com. That's short for Praxis Capital. It's praxcap.com. You can also follow me on Instagram at Investor Brian Burke.
Awesome. All right. Again, really appreciate you for doing this interview with me today.
Thanks for having me. This has been a lot of fun.
Awesome.